the world of emerging market currencies just shifted under our feet. In the last 24 hours, whisper-quiet conversations among currency traders, investors, and analysts have turned into an electric brainstorm of urgency and speculation. And today, we bring you an urgent update on two of the most closely watched currencies, the Iraqi Dinar and the Vietnamese Dong. We are seeing heightened activity, amplified chatter, intensifying scrutiny, and a clock that appears to be ticking louder than ever. We are not here to seed baseless hype. Every claim we bring you is rooted in confirmed developments, but anything can change, and the margin between fact and rumor has never been thinner. We bring this to you only with the seriousness the topic demands, because we know how fast momentum can build, and we know how sharp the downside can cut if assumptions prove premature. Around midday, several credible sources began pointing to renewed interest in the Iraqi dinar among institutional investors in the Gulf region. We're not talking internet forums or fringe online groups this time. We're seeing real demand emerge among regional family office networks, emerging markets desks at investment banks, and sovereign wealth fund monitors quietly preparing scenario analyses. This interest is tied to recent signals from Baghdad that they're taking practical steps to manage the dinar's external convertibility, and those in the know say that memo-level discussions are now underway about piloting controlled exchange rate deregulation mechanisms. If implemented, even partially, such maneuvers could accelerate capital inflow and trigger a repricing, consistent with what some of those desks have flagged as a 4 to 6 dinar scenario against the US dollar. We stress that specific numeric speculation remains unconfirmed and subject to extraordinary policy decisions. Over in Southeast Asia, the Vietnamese Dong is gathering momentum of its own. For months, Vietnam's state bank has been navigating a tricky path between export-oriented monetary flexibility and currency stability. Now, according to trade finance intermediaries and local commercial bankers, there are growing indications that the state-controlled central bank may adjust its tightly managed peg, either widening the daily trading band or repositioning the reference rate against the dollar. We have confirmation that internal communications to commercial banks have hinted at a revisionary approach to FX margins, especially in light of mounting external pressure from rising global interest rates and a need to maintain export competitiveness. That language may sound opaque, but market participants are watching closely because even a small shift, say, a 200 to 400 dong adjustment, could cascade through import-export pricing, cross-border remittances, and offshore trading activity. What does this mean for you, or for any investor watching this space? First, recognize that the configuration of each of these currencies is not starting from zero. The Iraqi dinar has been tightly managed for years, with most trading confined to domestic banks or black market circuits, and the Vietnamese Dong has only ever been marginally convertible outside Vietnam's borders. Liquidity is low, regulation is strict, and both economies operate under unique political and financial constraints. That said, these very constraints are what make any move potentially explosive. If either government pulls even one lever, loosening restrictions, adjusting multiples, altering bid-ask spreads, the result could be dramatic, even fleeting. We're not talking about a systemic collapse. Rather, we're talking about the kind of sudden repricing that collectors, speculators, and few on institutional desks long hope for and equally dread. Let's take the Iraqi dinar first. In Baghdad, the Ministry of Finance has discreetly signaled to international financial advisors that they're studying a dual-rate framework. The public narrative remains cautious. Officials point to macro stability, oil price volatility, and regional security concerns as reasons for maintaining the status quo. But behind closed doors, investment banks have quoted internal fee forecasts tied to liquidity injections, currency swap facilities, and the possibility of a managed float. The key question now is, are these signals merely exploratory, or are they about to shift into execution? Our sources in Amman and Istanbul say that some of the Gulf-based financial houses have already started allocating small testing orders, within controlled sizes, into the dinar, setting up anticipatory trades should Baghdad go live with any form of loosening. Those are not sweeping positions. They're market probes. And their arrival is enough to spark renewed demand. Anecdotal reports today suggest dinar spreads on informal FX platforms have already begun to tighten, with a slight uptick in volume at price levels not seen in months. Even a 10% move in either direction could electrify existing speculative flows. It's not beyond the realm of possibility that within days, whispers become roars. Turning to Vietnam, the calculus is different, but no less sensitive. The Vietnamese state bank has historically managed the dong against a basket of currencies, with tight daily bands of fluctuation, sometimes only a few tenths of a percent. Banks, exporters, importers, and remittance services have all known the playbook. But the world has changed. Global rates are higher, capital flows more fickle, inflation pressures persist, and export competitiveness is paramount. Market sources indicate that the state bank has convened discussions about whether to decouple slightly from that rigid band or to revise its reference rate higher against the dollar, potentially triggering a small devaluation. The central bank's reasoning, we are told, is to preserve export margins, to calm local FX demand, and to shift toward a more flexible but still controlled regime. Now you have these two currencies, both tightly managed, both emerging markets, both facing internal pressures and external scrutiny. And right now, both are showing signs of shifting. The key here is that ahead of any official policy declaration, be it in Baghdad or Hanoi, real capital is quietly positioning itself. That positioning may be invisible to most. You won't see large public orders hitting New York or London trading screens just yet. Instead, it's happening in underwriting lines and internal risk desks where contingent sweep orders are being placed and small blocks are being readied. What does that look like on the ground? For the dinar, small lot bids are now being placed through Gulf Emirate FX desks, as we noted, gaining traction among niche hedge fund intermediaries. For the dong, a handful of trade finance desks in Singapore, Hong Kong, and even Dubai are quoting slightly less favorable forward points as they anticipate a shift in Vietnam's FX policy stance. And in both cases, the term anticipatory hedging is back in whispered circulation. At this point, private FX brokers and money market houses are updating their model algorithms, adjusting for higher potential variance in mid-range horizons. In simple terms, both currencies may be more volatile in the near future, even if that volatility is incremental. We must underscore, neither government has issued public confirmation of imminent change. Official press statements remain carefully neutral. Baghdad reiterates its commitment to a stable exchange rate, citing oil revenue sensitivity. Hanoi continues to affirm tight-banded policy, aiming for inflation control and financial system stability. That's the public posture. Stable, cautious, watch and wait. But the private posture whispers of change, of new structures in motion, of strategy shifts just beyond the official disclosure line. To you watching this unfold, our recommendation is to remain alert, disciplined, and process-driven. If you are a speculator, collector, trade finance officer, diaspora remitter, or institutional currency strategist, what we're witnessing now counts as an early phase: positioning, testing, data gathering. You are not late. At best, you are witnessing the setup. But that very setup can morph quickly, with statements, speeches, policy memos, even leaks. The lengths between anticipation and realization in these kinds of moves can be narrowed in hours, especially if credibility fractures or economic pressures crescendo. We also want to caution passionately about risk. Even if a movement happens, execution may be partial, short-lived, or narrowed to segmented channels, retail, wholesale, or certain FX centers. And any move may be reversed or recalibrated. For example, a repositioning of narrow bands in Vietnam might be tightened again if inflation returns or capital outflows accelerate. In Iraq, initial deregulation signals might be scaled back amid oil price shocks, domestic instability, or external pressure. By the time moves are signaled publicly, those primed in advance may have already exited, leaving latecomers exposed to whipsaws, regulatory bridges and gaps, or legal ambiguity. Let's talk about scenarios. In one scenario, Baghdad announces a partial managed float pilot within the next 2 weeks. That could trigger a fresh wave of speculative flows, narrow official spreads, and spark visible prices on some FX portals. If that occurs, You'd expect to hear statements like FX liquidity to increase, controlled rate divergence, and